I'd like to introduce Dr. Brent Young. He serves as an agricultural business management economist with the Colorado State University Extension. Brent strives to help farmers and ranchers manage risk through the development, delivery, and evaluation of non-credit education programming. Additionally, he provides information on Farm Bill Title I production support and Title 11 commodity insurance programs, crop and livestock enterprise analysis, financial management strategies, and commodity marketing. So without further ado, Dr. Young, please take it away.
Thanks, Nick. It's a pleasure to be with you this afternoon. It looks like you've had a great program up to this point, so hopefully I can continue the good work that people before me have been a part of. I'm going to go ahead and share my screen at this point. And Nick, I'm just going to ask you if the PowerPoint presentation is visible at this point.
It looks great.
Okay, and it's in the view mode as well, Nick?
Yes.
Okay, great. Okay, so I want to spend a little bit of time talking about corn outlook very briefly, and then get into a longer, more detailed discussion about corn marketing. And having looked at the program, I think you've had some really good outlook information prior to my presentation today, so I may go through that rather quickly, maybe just focusing on a balance sheet that one of my colleagues at CSU, Dr. Stephen Kuntz, has put together to give you kind of a feel for what we might expect for corn prices to do based on planted acres. And obviously we've got a planted acres report coming out next Wednesday, so that should give us some idea as to where the market might be heading. As Nick mentioned, I'm a regional extension specialist. The area of specialty for me is agriculture and business management. I'm located at the Northeast Regional Engagement Center here in Sterling. That's a photo of the office. The office address is 304 Main, Sterling. If you're familiar with Sterling, Colorado, my office is on the corner of 3rd and Main, and we're right across from the Logan County Courthouse. As with many of my colleagues in Extension, I have a job description that's fairly lengthy, but what I like to do is kind of focus in on what I feel my major responsibility is, and that's really to help farmers and ranchers manage risk. And we all realize that agriculture by nature is a very risky business, and that those people who are most successful in agriculture tend to be those who have been able to identify those risks and are really good at mitigating the risks that we have that are inherent to agriculture as an industry. One of the things I would want to draw your attention to, myself and my two colleagues, Jeff Turnell, who's in our office in Pueblo, and Junie Byerman, who's in the office in Grand Junction, have put together what we think is a really outstanding resource for farmers and ranchers, especially as it relates to risk management in agriculture. And rather than trying to have you jot down a very lengthy URL or web address to get you to this website, I would simply say if you would Google, or whatever search engine you prefer, just Google CSU ABM. Typically the first hit that you'll get on that result page will take you to this website. I think it's an excellent website. I would highly recommend, once you get there, bookmark it, because I think it's one that you'll be returning to on a fairly regular basis. So again, I mentioned I want to spend just a few minutes on corn outlook. Again, I think you've probably had a chance to have speakers cover this in probably more detail than I'll be able to this afternoon with you. But just as we all know, we've seen a very welcome uptrend in the corn market, something that should be exciting for all of us. One of the things I did fail to mention is I'm also a fellow corn producer. I do farm with my wife, son, and daughter-in-law. We have an irrigated farm north of Sterling, and our predominant crop is corn. So not only as an ag economist, but certainly as a corn producer, I'm pretty excited about what I see when I look at this chart. Planted acres, again, we mentioned that we'll be getting a planted acreage report next Wednesday. It'll be interesting to see how that goes. But generally what we see in this particular slide is that we have a bit of an uptrend in planted acres for corn for the U.S. Corn yields, this is one that we're all familiar with. I think this is a really a powerful slide that not only do I like to share this obviously with producer groups, but also the public in general, especially those who aren't involved in agriculture, because this really tells the story of how productive we are in this country in corn production to have such an upward trend in yields over a long period of time. It's a real success story. And especially when you look at this and consider that we're able to do this, improve these and increase yields on fewer and fewer natural resources. I think this is just definitely a story that we've got to tell. Ending stocks, again, we see those building a little bit in terms of, or excuse me, decreasing a little bit, which is good news. Obviously, that's has some positive effect on the market as it currently stands. A little bit of a look at production and use of coarse grains, which includes corn. And again, we've got increase in production, but also increase in usage. And as you can see, that is resulted in a fairly steady decline in worldwide coarse grain stocks, which again is certainly bullish for our corn market. Corn usage, we see the big areas of use here, and certainly we're all aware of the downturn in ethanol due to the pandemic. Obviously, we're all encouraged to see that as gasoline usage has increased, that we're also seeing an increase in that ethanol use, a slight increase in that. And then certainly the big picture here obviously would be in that bottom red line with the exports and predominantly the export market to China. Coarse grain exports, and you can see that by far and away, we are the biggest player for coarse grains, but certainly have some fairly substantial competition with coarse grain production in both Argentina and Brazil. Corn basis, again, we've seen some improving basis numbers. Certainly that's positive for those of us that produce corn here in Colorado. Certainly our cattle feeding and ethanol industries have made us a net deficit state for corn production. And so certainly that bodes well for our local basis levels. Basis deviation, this is a 3-year average basis. And again, we can see some pretty good news there in terms of positive basis numbers for Colorado and especially northeastern Colorado. December corn chart, obviously this is an important chart for us all to take a look at as we are using this December contract as the contract we typically contract new crop corn in. Again, some very positive trend lines as we look at that corn contract. This green box really refers to that typical trading range that we've seen the past several years, and certainly to see that December corn contract way above that typical range of the last few years is certainly good news. This is the chart I really wanted to get to, again, realizing that you've probably had some pretty good sessions earlier today regarding corn market and corn outlook. This is a balance sheet that's provided by Dr. Stephen Kuntz. He's a professor in the Department of Ag and Natural Resource Economics at CSU. And basically what Dr. Kuntz has provided is a high price scenario, a normal price scenario, and a low price scenario. And the biggest drivers here in the high price, normal, and low price scenario are really two things. One, planted acreage, and then secondly, national average yield. And so under a high price scenario, we're looking at planted acreage of about 91 million acres. That average corn yield coming in a little bit below trend line at 172 bushels. And that's going to result in a carryover of a little over 6%. And based on that carryover, Dr. Kuntz is pegging an average Colorado price at 575 a bushel. December futures at 550, and an average U.S. farm price at about 560. If we look at a more normal scenario, that's a 92 million acres planted, 176 bushels average, carryover of just a little above 10% stocks to use ratio, and then that Colorado average price at about 465. And then that low price scenario, 93 million acres planted, national average yield of 178.5 bushels, carryover of about a little over 13%. And then, as you can see, a market price, average Colorado price of about 385. So part of this equation, obviously, we hope to have some answers for with the report coming out next Wednesday, planting intentions, and then obviously those yield factors we'll have to take a look at as time goes on. Certainly, ethanol demand is a big player in this, and as hopefully we recover to more of a normal situation post-COVID, we'll see gasoline consumption and ethanol use go up, and certainly that helps with the balance sheet and the price of corn. So a little bit about outlook. Again, I think this is probably the more important slide as we look at a balance sheet. Then based on that, just generally outlook, currently market price going to follow soybeans and a negotiated acres type of a scenario. So we're looking at that soybean planted acreage pretty closely as well. So what's the acreage going to be this year? Certainly demand, trade, ethanol, and again, that price outlook between $4 and $5, kind of based on the scenarios that were presented in the previous slide with the balance sheet. So what I really like to get into at this point is kind of the bulk of the program this afternoon, and that's looking at marketing corn. And marketing corn and marketing in general is kind of a passion of mine. I offer a number of online marketing courses. In fact, we're just completing one now. It was an 8-week course that we'll complete next week. Kind of a general marketing program that not only covered grain marketing, but also livestock marketing. And so I like to approach my marketing classes from really this feel of a theory of, rather than trying to help you always hit the top of the market year in and year out, that maybe a better approach to helping people understand grain marketing to do a better job is to identify some common mistakes that we all make in grain marketing, and then trying to do what we can to eliminate these mistakes. And I'm going to attribute this approach to a gentleman by the name of Ed Ussett with the University of Minnesota. And I've taken Ed's ideas here and made some modifications that I think make this pretty appropriate for marketing grain in the Great Plains in our region of Colorado. Ed's theory here, and he likes to relate this to a professional tennis player. He said most professional tennis players really don't concentrate on trying to serve an ace every time they serve the ball. Most tennis players really look at, the good ones, the professional tennis players, they look at identifying the mistakes in their game and trying to eliminate those mistakes. And by eliminating the mistakes, then they have a higher level game. And so I think that's a wise way to consider grain marketing, rather than trying to market at the top of the market every year, which is impossible to do, I think, on a consistent basis. I know I can't do it. I also know if I could, I probably wouldn't be talking with you right now. I would be on a private island that I own somewhere in the Caribbean, because I've made a ton of money trading corn futures. So let's look at those common mistakes that we all make in grain marketing. One is not knowing your cost of production. Number two, reluctance to pre-harvest price crops. 3, failure to understand and track local bases. 4, failure to have a pricing strategy. And finally, holding unpriced grain in storage too long. And as I mentioned, these were inspired by Ed Ussett, University of Minnesota. So what I would like to do with the time that I have remaining is go through each one of these and talk about techniques that we can use to eliminate these mistakes. And as I mentioned earlier, as a corn farmer myself, I try to utilize um, these techniques myself, and and we do use these on our own farm in our own crop marketing program. So the first mistake we all make is not knowing our cost of production. And basically, cost of production is the dollar value of all the inputs for growing a specific commodity. We're probably all aware that there are two big components in cost of production. That's our fixed costs, which are sometimes called overhead costs, and variable costs or direct costs. Some examples of fixed costs: land, taxes, insurance; variable costs: seed, feed, fertilizer, and fuel. So another way to look at this: fixed costs are those costs that we incur regardless of our level of production. Um, Whether we produce 1 bushel of corn or 100,000 bushel of corn, we still have a land payment to make. We still have taxes to pay. We still have insurance to pay. Variable costs, on the other hand, as the name implies, do change with our level of production. So certainly the more acres of corn we have in production, we're going to spend more money on seed, more money on fertilizer, and more money on fuel. And it's been my experience that most producers have a pretty good handle on variable cost. And typically, when I ask producers, "What's the cost, your cost of production to produce corn?" I typically get their variable costs, and they're very good. They're within a few cents of per bushel of what their variable cost is. Fixed costs are a little bit more difficult to come up with, and certainly if you have an operation that has multiple enterprises, it's difficult to determine how much of each one of those fixed costs do I attribute to each enterprise. So it takes some effort to be able to do that. Knowing your cost of production is essential for enterprise selection. It's also essential uh, for developing a marketing plan. And so we're going to focus on that second bullet and talk about why it's important for developing a marketing plan. We need to know our cost of production in order to be able to determine if the market is offering us a price that will cover cost of production and hopefully produce a profit. And so we'll talk a little later on about developing marketing triggers. And those triggers are typically based on this idea of what is our total cost of production? And again, can we market at a time when the market is offering us a price that's above that cost of production? I'm going to talk briefly about a method to do this using Quicken. The reason I talk about Quicken as a record keeping system is a number of small and medium sized family farms here in northeastern Colorado utilize Quicken. They utilize it because it's pretty simple and easy to use. It's readily available and it's relatively inexpensive. The problem with Quicken is it was designed to help you track your personal finances. And so we've got to manipulate or trick Quicken a little bit to get it to do a good job as an agricultural record keeping system. I do have a great website here for you, though. Oklahoma State University has for years supported a website that provides information to producers who use Quicken on how to manipulate it and adapt it for ag purposes. Again, I've given you a web address here. If you simply would Google OK State Quicken, you'll get to this website. The website has a couple of really important and really good free pieces of information. The first thing is this Quicken for Ag manual. We happen to use Quicken on our old farm, and I have this manual downloaded, printed. I've three-hole punched it. I've got it in a notebook, and it's right by the computer. Because even though I use Quicken on a regular basis, there may be techniques that I forget about, and so this is a great reference to help me utilize Quicken better. In addition to the manual, the website also has a series of sample files. So if you're new to Quicken and you want to maybe take a look at and evaluate if this is the software you'd like to use, you can download these sample files that have sample entries and work through the workbook in order to manipulate these sample entries. If you already use Quicken, but you want to learn how to use some of these advanced functions, what I would recommend is download these sample files and manipulate the data in the sample files to learn how to use Quicken better. That way you're not putting at jeopardy your own personal information. So between the guide and the sample files, a couple of really great free references on how to use Quicken better. So what I'm going to talk briefly about is a function in Quicken known as the tag function. And so if you are familiar with how Quicken works, when you enter either an income or an expense item, you have the opportunity to determine what part of that expense would be attributed to a certain list of categories. So in this case, we have an expense, a check written for $4,571.40. I believe it was written to the local co-op. So of that amount, $571.40 was spent for farm supplies. We know it was fencing materials. And now what we've done is we've tagged it to our cow-calf enterprise. And so we can go through and separate out all of the income and expenses designated to the cow-calf enterprise to help us determine cost of production. Here we can see we had chemicals. Those were purchased for a wheat enterprise, and those were amounted to $4,000. So every transaction we make, either income or expense, we can assign that income or expense to multiple enterprises. Then what we can do at any time is produce an itemized tags report. And so basically what we have here is all of the income that's been attributed to the cow-calf enterprise, the family living enterprise, and the wheat enterprise. We also have all of the expenses that have been attributed to those enterprises. We also have a category you'll notice is known as untagged. And I find this very helpful as I am entering information into our Quicken account, especially in the summer when we're busy in the field and I don't have time to maybe enter more than just the basic information, mainly to make sure that the checking account is not overdrawn. And so sometimes I may not put this tag on each one of those income or expense items. But what I can simply do is just pull a untag report, look back at those entries, and then go back and re-enter the enterprise that generated that income or expense under the tag function. And so this makes this fairly simple. For example, if that was the total expense for the year for that wheat enterprise, I could simply take that number, divide it by the total production in bushels, and have my cost of production per acre. So the bottom line here for me is it's such an important thing for you to be able to do. A person really ought to take a look at the record keeping system that you're utilizing for the financial records for your farm. And if you can't produce cost of production, or you can't produce at least expenses by enterprise or by crop, you probably should be considering looking at another record keeping system to make sure that you're able to do that. So the next point I want to make, or the next big mistake we make, is a reluctance to pre-harvest price crops. And I'd like to show you with the next couple of slides why this is so important. Here's some work, again, Ed Ussett has provided. Ed looked at the December corn futures prices from 1990 to 2014. And he looked at those prices on May 1 and October 1. And what he found was in 19 out of 25 years, or 76% of the time, the price of the December futures in May was lower when we looked at that same contract in October. Corn prices dipped lower in 3 of the 4 years by an average of 29 cents a bushel. And so basically what this is saying is that 3 out of 4 years, the corn market is going to provide you an opportunity to price your commodity at a price that's going to be higher than you're going to receive at harvest. It's very pronounced. You know, I wish we could take that kind of odds to Vegas. We'd all be rich. So it's something, especially in the corn market, that we really ought to consider. Here's a way to look at it on a more visual graphical basis. This is looking at corn futures seasonality for 37 years. And basically you can see the top of that corn market is in that June, July period of time. If we go down to harvest, we can see that, as we all know, the corn market dips off considerably. So if you take nothing else from what I'm talking about today, I would implore you to think about pre-harvest pricing a portion of your corn crop. It's that important. Certainly, there are a number of methods to do this. Some of the common ones would be the use of foreign contracts, hedging with futures. We can also set price floors and ceilings with options. There are a number of different ways to do this. So many methods are out there. Again, we cover all three of these basic methods in an ag marketing course. Now, some of the concerns that producers have when I talk about pre-harvest pricing corn, one that comes up is, well, what if I don't produce enough bushels or pounds to cover my contracts? Well, that's where revenue protection crop insurance, our whole farm revenue protection commodity insurance comes in. Through these programs, we can guarantee a certain number of bushels through the insurance, such that if we have a hailstorm and we lose a crop, we still have the revenue from that insurance product or that insurance policy coming in that would allow us, if we have to either buy corn on the open market and replace the corn we contracted, or in most cases, just to be able to pay the penalty for not being able to deliver all of those bushels. So it's a way for us to ensure that we're able to fulfill our contracts. The other question is, well, this is all well and good, but what if I miss an opportunity? What if I sell and the price goes higher? So there are ways we can get around that. We can develop marketing plans, and I'll show you one in a few minutes that includes scale-in selling, or we can use options to set a minimum price so that if prices go higher, we're able to capture that higher price. So there's ways that we can get around both of these concerns when it comes to pre-harvest pricing our corn. Probably most all of you on the Zoom call this afternoon are aware of revenue protection crop insurance. It's been around for quite some time. I think over 85% of all the corn grown in the United States is covered by revenue protection crop insurance. So fairly common. Again, probably as corn producers, you're pretty familiar with it. One product you may not be aware of is whole farm revenue protection. This policy was made available as a product for the entire country with the 2014 Farm Bill. It's been upgraded and improved during the 2018 Farm Bill. A couple of improvements. One is we do have a limit now of up to $17 million insured. And if you've got an operation that includes livestock, you can cover the livestock up to $2 million. Basically, you apply for this insurance, you submit 5 years of your Schedule F. We use those to determine the average farm revenue. You also submit an operations report indicating the commodities that you expect to grow, what you expect your yields to be, and your expected prices. And then the amount of revenue that's covered for the year of coverage is the lesser of your 5-year Schedule F average, or what you intend in the year of coverage. As with revenue protection, you can select coverage levels from 50 to 85%. One important point, unlike other forms of crop insurance, where we don't know that you've had a loss until you file your Schedule F for the production year. So it may be the spring following the production year before you can know that you have a loss and get a payment. Again, it requires some record keeping, that 5 years of Schedule F, which is typically not an issue. If you're a beginning farmer rancher, you only have to submit 3 years of reporting. This farm operations report, the intended is filed to get the insurance coverage. If you make changes during the year, you file a revised, and then the final report would be used to determine if you have a claim or a payment. Also include other insurance policies because any revenue from those is pulled off. If you do direct marketing, you have to provide inventory. If you store crops between 2 tax years, you have to provide inventory, and then also information about accounts payable and receivable. One of the big advantages with this type of insurance, it has one of the highest subsidy ratings of any crop insurance program that we have. And as you can see, if you have a situation where you're insuring 3 or more commodities, once we get from that 50% level of coverage all the way up to 75%, the premium subsidy rate is 80%. Typical crop insurance is about 50 to 55%. So you can see this is a product that the RMA really wants us to use. And so they've put some incentives in front of it. One other couple quick concerns, you also have to document qualified expenses at the rate of 70% of your income. Typically for most operations, that's not an issue. As I mentioned earlier, payments from other crop insurance policies are deducted. And sometimes if we have several commodities, it based on the commodity totals for each one of those, you may want to add some additional insurance. You could have a total loss of one commodity, but it wouldn't be a large enough percentage of the commodity mix to trigger a loss. So something to talk about with your crop insurance agent if you're interested in looking at whole farm. Again, it's really tailor-made for organic producers and diverse operations. And I think it still might, because of those high premium subsidies, be something that large commercial operations might want to take a look at. I used to tell people that this might be an alternative for livestock producers, but they've made some real changes in that livestock risk protection or LRP program. And so it may not be as big an advantage for livestock producers as it once was. Okay, the third mistake we typically make as marketers is failure to understand and track local bases. And the reason that this is an issue, it's very easy for us to get really fixated on the markets and watching those markets on these devices that are become part of our anatomy. And sometimes we might miss some real opportunities that happen with prices locally as basis changes occur day to day. So just a quick refresher, remember basis is the difference between a cash price and a futures price of a particular commodity on a given futures exchange. Basis is determined by local demand, freight costs, could be other factors. Typically cash is lower than basis, and when you say basis is under, when cash is higher, basis is over, and we sometimes see that in corn basis, especially here in northeastern Colorado. When the spread between cash and futures decreases, we say basis is narrowing. When the spread increases, we call that basis widening. And then finally, when cash and futures are equal, basis is said to be zero. So I want to talk about a couple of online resources you can use when we talk about basis. One thing that's important for us to do is be able to predict local basis. And fortunately, basis does follow some normal patterns. It's fairly easy to predict. This is especially important when we're looking at utilizing a method to forward price our commodities, realizing eventually we've got to sell those commodities in the cash market. And that difference in basis has an effect on the bottom line, what we're actually going to get for the commodity. So one tool, this is a free tool. This is from Kansas State University. It's called their Interactive Crop Basis tool. Again, if you were to Google Kansas State Interactive Crop Basis tool, you would get to this site. It gives you an opportunity to put in either a city or a state or a zip code. It has several commodities that you can take a look at. You can pull a basis information, average for 3 years, average for 5, or individual years, and we can create either a chart or a table. Luckily, most of the markets in eastern Colorado are tracked by this particular tool. And so I put in Pete's, Colorado. I'm looking at corn. I want a basis information for the average of the last 3 years. And then I can click either create a chart or a table. In this case, I can create a table for that particular market, and it gives me an idea what basis is doing relative to the futures market, and on a look at various weeks through the marketing year. If I want to do this in a table form, I can take it and ask for that. Again, I have the week of the year and basis for that 3-year average. Again, these numbers are in parentheses, meaning that is basis under. So a great way for me to be able to predict what basis might be for a local market. Again, helping me put together, make a decision if I'm willing to pre-harvest price at a certain level. The other thing that we'd like to be able to do in addition to predicting basis is track it. And so I've got a bit of a product disclaimer here. We're going to move from a free site to a site that charges, so a commercial site. The attorneys at CSU forced me to put this up, basically saying, as a CSU employee, I can't endorse this or criticize it, but I'd like for you to at least be aware of it. This site is known as GeoGrain. Again, if you Google GeoGrain, you'll find it. It does have a 14-day free trial. The thing I like about that, as opposed to some free trials, they don't collect your credit card information. It's truly a free trial. And so this does a great job of helping you track local basis. And so one of the things that you're able to do in this program is designate the address or GPS location of your farm. So our farm is Young Land and Livestock. If you're familiar with the Sterling area, this is North Sterling State Park. And our farm is kind of in this area right here where the pointer is. And so I was able to pull up a corn spot delivery basis map. I chose a distance of 100 miles around our farm north of Sterling. And for that particular day, it gives me the relative basis levels for all of the markets within a 100-mile radius. It utilizes a stoplight function, with green being good. In fact, on that particular day, Seaboard Farms had the best local basis at 19 cents under. Yellow, I talked about that Pete's Market, it was 35 cents under. Orange, and then finally, those areas at the basis was the widest are indicated in red. So a good way for you to track local basis. It also provides some basis charts. One of the things I really like about it, as you can see here, in addition to the chart for the markets I have an interest in, it also gives me a line for that region. And so I'm looking at that 200-mile range. And again, this is a 5-year chart. So I can see as compared to that region, this is a pretty good market as it relates to basis. The other thing it'll provide for you in an email message at the end of the day is a look at cash bids. You can also put in your cost of grain transportation, and it'll organize these cash bids based on the distance to the market, your cost of transportation, and basis. So again, with a couple of these tools, you can certainly predict and track basis, which is a very important thing to be able to do. Mistake number 4 is failure to have a pricing strategy. And that's all about market planning. And typically when we talk about corn marketing or marketing any grain, we talk about pre-harvest marketing and post-harvest. So it's important that we develop a pre-harvest market plan. This is really a strategic or a planned approach. We need to know what our cost of production is. Our best source would be actual historical data from our records. If we don't have that, if you've produced a cash flow for renewing an operating note, you could use that information to determine a projected cost of production. And then finally, we need to know how many bushels, pounds, or head we plan to market. And again, to do that, we utilize commodity insurance to determine our guaranteed production. So what I'd like to show you here is an example of a pre-harvest marketing plan. Again, this is good old Ed Ussett from the University of Minnesota. There is a typo here. This plan would have actually been initiated or developed, I should say, December 12th, 2020, because it's for the 2021 production year. So Ed expects a production of 10,000 bushels. He's going to buy crop insurance to cover 75% of his projected bushels. And so he's looking to have a marketing plan for 75,000 bushels. And so here's where we see an example of having a pricing plan or set of triggers. A trigger includes, at a minimum, the amount of commodity you plan to market, typically at a certain price. Ed is providing a cash and futures price, and then a method of marketing, and then typically one other thing would be a date. So you can see subsequent to this first action here, which really would say anytime after I've established this marketing plan in December of 2021, if the market provides an opportunity to sell cash at 375, futures at 425, I'm going to do it. But then the subsequent ones then have an expiration date. By this date, if the market is offered this amount, or this price, I'm going to sell this amount of commodity, or price this amount of commodity. And so you can see here's that step up approach: 375, 405, 435, 465, 495, and finally 5.25. And so that's a way we hopefully can ensure that we're catching a market on its upward trend. Post-harvest planning, this is more of a tactical approach. It has to do with our ability to use storage, either on farm or storage that we might purchase. By now, we should have actual cost of production. Crop insurance is not important. We're really looking at what the market offers in the form of carrying charges and basis changes. If prices rise after harvest, then what are our opportunities to capture those post-harvest improvements? And again, these post-harvest plans, those are the ones that change probably more year to year, as our pre-harvest plans tend to be a little bit more stable. Here's an example of a post-harvest price plan. Again, you can see the date on this is October 16th, 2020 for the 2020 crop year. Obviously, we're not going to develop a post-harvest plan until we're close to or have harvested the crop. In this case, we may have used a number of techniques to forward harvest price other than forward contracts, because we still have corn that we need physical corn we need to market. And so this would be an example of a post-harvest plan. And then finally, the last mistake we make if we do have on-farm storage especially is holding unpriced grain in storage too long. Obviously, we store grain because it speeds up harvest, and also it's an opportunity to avoid having to sell at harvest and taking typically the harvest price lows. The problem with this comes with we hold too long, because typically we see new crop futures pretty strong in the spring. Usually those new crop prices are a threat to the crop that's in the bin. The other thing we have happening is we see a weakening of basis for the old crop. So we're having old crop futures decline. We have local basis widen, and that becomes a real double whammy in terms of the price and the value of the old crop that we've got in storage. So I'm going to go ahead and stop at that point. Nick, I think I do have a few minutes for questions. Are we still kind of on schedule in that regard?
We are, Brent. You did a great job there. I would like to interject one thing. You did mention something about the whole farm revenue plan. One thing I wanted to mention that is the Colorado Corn Administrative Committee has been funding a investigation into basically what we've internally dubbed Whole Farm Light. We realize the benefits of that program, and I believe we let you have a look at it. We realize the benefits of that program, but some of the things are a little restrictive for crop producers. And instead of trying to adjust that program, which specialty crop users and are very fond of, we really put in the effort into adjusting and writing up a new program to present to RMA, and we called it CLIP, or the Crop and Livestock Indemnity Program. And really what it does is it establishes a companion policy for row crop and livestock. It abandons the reliance on tax records. It eliminates the expense reporting because we have good farming practices in the grain side of things. And then it relaxes the premium discount restrictions. And so this has been turned over to RMA, and we're really looking forward to possibly having this as an option for our producers to have that higher level of coverage. If you are able to qualify for 3 commodities at the same time, kind of the same requirements as what is in whole farm, but it also includes a way to insure livestock at that higher rate as well. And so something that we've been investigating as the administrative committee that could possibly end up having some tremendous benefits for producers in Colorado that have very often have diversified operations of 3 or more commodities.
Yeah, Nick, I appreciate you talking about that. Actually, I think had some email traffic the last few weeks about that, and hopefully that will be considered by RMA. I think that would be a tremendous improvement to that program.
Yes, and so we're excited about it. Just wanted to, before we get too far along, we did take a poll real quick of our participants of who has a marketing strategy or plan in place for this year. And it looks like a little over half do, so that's great. And for those that didn't, hopefully this will help give them some ideas of what they can do in this upcoming crop year before we get the seeds in the ground. Also, I wanted to let everybody know that if you check out the chat, I've been putting the links that Brent has been talking about to Oklahoma State, and as well as the Kansas State Basis Manager. I missed the Geo one, but those are in the chat as well. If you'd like to click on those, go to those, and bookmark them for your future reference.
That is great to see the level of plans in place for the 2021 corn crop. I work with various commodity groups across the state, and I can tell you that's the highest level that I've seen. So it certainly speaks to me about the level of sophistication corn growers in this state have when it comes to marketing. That's great news.
Yes. So one question I did have for you, Brent, is you mentioned the classes that our growers could take on ways that they could market, the ways that they could hedge, and really use the tools that are out there to their benefit. What are those courses, and how do they sign up for those so that they can take advantage of that and implement some of these things on their operations or in their operations?
Yeah, thanks for asking about that. I typically offer a class every winter. It appears that's usually the best time for people to take the classes. Unfortunately, as I mentioned, we're just about to the end of this course now. The classes typically start right after the 1st of February, typically run through the month of February and the month of March. Again, I go with an 8-week program. We meet one night a week for 2 hours. We do record the session, so if you miss a session, or what I find is a lot of producers who attended the session live will go back and look at a recording and kind of scroll through to get to the point that maybe they didn't understand the first time. So that tends to be very helpful. The first 4 weeks are really basic. We talk about cash markets, we talk about the basis, futures and options. And then the last half, we get into some pretty sophisticated marketing tools. I like to think of marketing as a toolbox. And so I want to give you the toolbox. I want to give you some tools to use. And then we spend some time on how do you select the right tool, and based on what market conditions are doing. And then the course ends with the development of a marketing plan that you can actually use on your own farm. In addition to the class, we also utilize an online trading platform where we can do some fictitious trading called Commodity Challenge. And so not only do you have the opportunity to learn about marketing, but you also get to go on this site. You have a fictitious portfolio of grains to market, and then we give you some assignments so you actually learn and get the feel for trading the commodities. And so I think it works really well to help introduce people to this idea of marketing. Many people may have had some formal marketing training years ago, but they don't use the techniques on a regular basis. So it also serves, I think, as a really good refresher course. Um, for people moving forward. One of the things I would offer, and I know you and I, Nick, have had some conversations about this in the past. If there was interest in a corn only program for Colorado corn producers, I'd be more than happy to put something like that on. And what I think would really be fun would be to have a corn only commodity challenge that we might run for an entire year. It may be a situation where by starting in February, you might have a fictitious portfolio that would include some old crop corn, and then maybe we would have some new crop corn that you would market. In a situation where maybe on a monthly basis we might just meet and talk about the corn market, continue our challenge throughout the year, and then maybe we could come up with some corporate sponsors and actually give some cash gifts or something to the top. Um, People in the challenge. So just something to throw that out there. If that's something the membership would be interested in, we could certainly do a corn only or a grain only marketing challenge and put something together. I think would work pretty well. I think you're muted.
Yeah, Ace, you got to do it at least once a webinar. Uh, that certainly piques my interest, Brent. And so that's something we can throw out and see if we can get some participation in. And I think that I remember my commodity challenge very fondly when I was at Colorado State University going through classes there. Let's just say I did not end up winning the class or a profit. So if there's any questions for Dr. Young, we've got about 6 minutes or so before we have to turn over to the research side of things with Colorado State University. Please either raise your hand or throw them up in the questions and answers, and we can get those out there. Jeremy, do you have any questions for Brent?
Yes, I do. Dr. Young, could you maybe speak to HTAs or heads to arrive contracts for any of our attendees who may not be aware of them or are perhaps a little reluctant to sell their grain or pre-contract their grain before harvest? And also staying on the HTA topic, is there a formula or any guidelines that you use when using HTAs? Are you comfortable with someone using 100% HTAs, or would you like to see them lock in a certain percentage of basis as they are contracting throughout the year?
Okay, so the hedge to arrive contract, and Jeremy, you and I may be talking a little different language here. So typically hedge to arrive is you lock in the futures price, you let the basis float, and then lock in basis at a different time. That's opposed to a basis contract where you do the opposite. You lock in basis, and then you would lock in a futures price at a later time. And so what I normally do with a hedge to arrive and really any of the other techniques is, again, I consider that to be a tool, and I really look at what are the markets telling us? What do we think futures prices are going to do in the future? And what do we think basis is going to do in the future? And select the best tool based on that. The other thing would be a percentage of the crop that you have to market. I guess I'm not a big fan of going 100% one method or the other. I think you need to have an entire portfolio of methods that you use. Some methods you're going to use because not only are they most appropriate given market conditions, but also they are more comfortable to use. So I think that is another factor that comes into. And I'm certainly a very, very big proponent of never forward pricing more than you can guarantee with your insurance. I think that gets people in trouble. Markets like we have today that are really looking good, there's a real, a real challenge to hold the reins back, so to speak, and not market more than you've been able to protect from a guaranteed standpoint with the insurance. So we do talk about hedge to arrive. I don't talk a lot about I talk mostly about non-roll hedge to arrive, because we get into a roll situation, we can have some issues with that. So hopefully that's answered the question.
Yes, thank you. And I guess the comment I had on that chart you showed projecting the total production versus use, it's just amazing to see 14.8 billion bushels worth of demand, equating to 40.5 million bushels a day. It's really something that we can produce that much, yet the demand still stays there. And then 1.5 billion seems like a big number, but it is only just a 36-day supply.
Yeah, it's amazing when you look at those numbers, and especially as you've have, Jeremy, put them in perspective in terms of how many days supply that really accounts for. It looks a whole lot different when you consider it that way.
Mm-hmm.
And I did it again. Jeremy, do you have any more questions, or is there? I don't see any from the audience.
No, I do not. Thank you, Dr. Young, for speaking to us today. A lot of valuable information there.
Well, it's been my pleasure. And again, if I can be of any assistance, let me know. If there's interest in a corn marketing program and challenge, Nick, let me know, and I'd be more than happy to work with you to set something like that up.
It sounds like a great idea, Brent. We'll look forward to talking with you about that here in the future.